Hey, everybody. It is good to be here. It's Wednesday. I always look forward to Wednesdays because it's managing an options portfolio day. Glad you're taking a little time out of your schedule to join us. And I'm also glad to be joined by Mike Fairborn, who's helping me out in the chat. I appreciate Mike. Mike and I have known each other a couple decades now. And we're in addition to colleagues, we're friends. I've learned a lot from Mike over the years too. So I encourage you to check out his webcasts, including he does a ThinkScript webcast. So if you're interested in the Thinkorswim desktop, getting the most out of your Thinkorswim desktop software, make sure you check out that webcast. That occurs 3 o'clock on Thursdays. That's Eastern time. Of course, you can follow either of us on X at BrentMooreCS, at Mike Fairborn CS. Mike's on there. I'm on there for additional financial content and some other stuff as well. See some familiar names in the chat. Appreciate you guys. And if you're watching us on our recording, that's great too. We love you. We love you too. So just a few disclosures before we get too far into this. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. Paper money does not assign short options early. So that's a difference between the paper money platform and the live platform. And for the sake of simplicity, I'm not going to factor in commissions or fees in the trades that we demonstrate, but just realize they're a real thing to consider. All investing involves risks, including loss of principal. Schwab does not recommend the use of technical analysis as the sole means of investment research, and past performance is no guarantee of future results. Let's just take a quick peek at the markets before we get into kind of the subject at hand. This is the S&P 500. The S&P 500, by the way, is kind of, if you're kind of brand new to investing, it's kind of a standard index that people look at to view the market. There's pros and cons to the index. It's a market cap weighted index. So those big companies like the Apples and NVIDIAs and Microsofts of the world really push this index a lot more than the smaller companies out there. But nevertheless, it's 500 companies, and it is a way that people look at the whole market. You know, one of the traditional indexes out there is the Dow Jones Industrial Average. You guys are all familiar with that. That's only 30 stocks. So this is a bigger representation. By the way, for those of you who are interested, the Dow is not a market cap weighted. You know, when you're putting individual trades in, you may be very aware of how those trades, act. What are the characteristics of those trades? Is it bullish or bearish? If so, how much? That's delta, right? That's our option Greek delta. Super bullish, higher deltas. Bearish, negative deltas. We may talk about time decay. That's the option Greek for that is theta. And how that particular option trade, whatever type of option trade we're going to look at, is going to affect, that time decay is going to affect that option trade. Important consideration, it can help you or it can hurt you. Same thing with implied volatilities. And it looks like we may be having a little tech issue, perhaps. Did I lose you guys here? Okay, all right. I'm showing some chats there that are, anyway, let's move on. Sorry about that, everybody. So consider your individual trades, but you can also consider your overall portfolio. You can consider your overall portfolio here as well. So to do so, we can go to the Monitor tab right here. And thank you for the confirmation in the chat, everybody. I appreciate you on that. And when you look at your portfolio may be grouped. Here's my short verticals, and you can see your delta, but let's look at the whole thing. And so sometimes it's beneficial to ungroup it. How do you ungroup it? You go to one of the many 3-line menus here, but the one that's at the top of the position statement area. there. And what I'm going to do is I'm going to just uncheck where it says show groups. And then when I look at that, here's all my positions. Okay? And I can look at the total at the bottom of the page for those option Greeks. That's probably worthwhile to look at occasionally. Maybe not every day, but you can look at this occasionally. And let's do this. Let me just kind of consider. So here we have delta. That's going to tell us how any of these individual positions. Here, look, this is 100 delta. I have 100 shares of Bank of New York Mellon here, BK right there. And so 100 delta, that tells me what that's doing. And Caterpillar, I have an 82 delta. This is a long call on there. And so, hey, that's what each of these individual positions are. But when we're trying to assess the whole portfolio, you probably want to beta weight it. And for our purposes, we're going to beta weight to the SPX. What do I mean by beta weight? What I mean is this. When one of these individual companies goes up, it tells me nothing about how much this other company is going to react. Furthermore, some of these companies are $500 share price, and some of these are $20 share price. And a dollar move up in one isn't a dollar up move up in the other. So by beta weighting, we can kind of just put these all on the same scale, all these deltas on the same scale, and say, how much is my portfolio going to go up or down based on a move in SPX? Okay, so we're going to look at that in just a sec. That's what beta weighting does. Now, we don't beta weight theta because theta is just the time decay regardless of what theta is like 1 day at a time movement here. And so as each day passes, so we're not beta weighting Vega or theta there. What we're doing is we're going to just look at the delta. How do I beta weight? Here's how you beta weight. You got to go up to the top here. You check on beta weighting, okay? And now what I'm going to do is I'm going to say, as I look at these, and here were my deltas, I'm going to type in SPX. And if you look at those deltas for a sec, look what happened to my deltas. All my deltas changed. All my deltas changed. What this is saying is, instead of if Apple went up $1, what's going to happen to the position? This is saying, what if the SPX went up a point? What's going to happen to this Apple position? Well, if SPX went up 1 point, we'd expect this Apple position to go up approximately, it's just an approximation, we don't know for sure, about $3.70. Now it's positive, so if the SPX goes up, we'd expect this to be bullish. Expect it to be a profit in that case. If SPX goes down 10 points, we'd expect this to go down about $37. You see how I did the math there, 10 points, multiplied that by 10, $37. So how much is 10 points? Well, look, 10 points isn't much on the SPX, to be very honest. The SPX right now is around $7,100, okay, right? So let's just kind of quantify this and say, what would a 1% move on a $7,100 index be? 1% move would be about 71 point move. How much is 1%? Well, that's a substantial day in the market, but it's not a huge day in the market. We're up almost 1% right now. Okay? And today, you can see today's candle, not massive by any means. So when we're going back here and we're looking at the monitor tab and we're saying, what would a 1% move on this be? We said, what do we say, $71? So I'd have to say delta 370, I'm going to use my calculator on this, 3.70 times 71 is equal to $262. And I'm rounding a little bit here, everybody. $262. What does that mean? That means if we get a 1% move up in the SPX, this Apple position is likely to go up very roughly $262 to our favor because it's positive. If the SPX were to go down 1%, it would probably hurt our portfolio, this Apple position, to the extent of $262. Now, this is one of the bigger deltas, but we could do the same thing for some of these others. Let's do this one. Let's do one more just to illustrate the point. Let's look at the Adobe position. Negative 0.25. If I take 71 times 0.25, I come up with about, we're going to say about $18. But it's negative. That means if the SPX goes up 1%, we would expect Adobe to go down to lose about $18. You got that? Now that's 1%. Think of 5% move. Think of a 10% move. We're probably not going to see a 10% move down in one day, but it can happen. It has happened. But, you can think of, here's the SPX. What if we go down from 7,100 down to, I don't know, this level back here over the course of a couple weeks? That's several percent move, okay? That's probably a 5% move there. You can do the math and assess the risk on your portfolio. Do the math and assess the risk on the portfolio. Let's look at the overall total on the portfolio instead of one individual position here, okay? So as I do that, one sec, okay? And I look at that delta. My overall portfolio has a delta of about 12.5. We'll just say 12.5. How's my overall portfolio going to move for that 1% move? 71 times 12.5 comes up with about, we'll say about, well, it's just shy of $900, okay? $900. So if the market as a whole were to drop, say, 10%, we're probably looking at about a $9,000 hit on our portfolio with a 10% drop in the portfolio. Now, some of you who have been around a little longer are saying, delta changes if the market changes. So it's not going to stay exactly at 12.5 if we go down 10%. That's true. This is just for a rough approximation. I want you to do this on your portfolio, though. And I want you to think about what kind of risk you're willing to take. In this portfolio, a 10% move would probably mean I'm losing about $9,000 in the portfolio. That may be too high for some people. Maybe now your portfolio is going to be different. It's probably not going to be the same as this portfolio. For some people, it's probably not unreasonable. It's not something we're looking forward to, not something we want to have happen. But look, if you're going to be in the market, there's going to be some risks there. But when we add in new trades, it will affect our delta. It'll affect our theta. It'll affect our vega. So I want to look at an example of that. In terms of managing your options portfolio, it's not just adding in individual trades. We do this every week in this webcast. We look at individual trades and we look at managing individual trades. But think about the broad, big picture. What's your theta? What's your vega? What's your delta? Now, the biggest factor is usually going to be delta there. Theta is nice if we keep positive, but just depending on the type of trade, that may not be possible. And vega just kind of depends on your implied volatility outlook there. Because if you think implied volatilities are likely to go up, we may look and I'm just trying to expand that out a little bit so we can see that full. I've got a lot of columns here. And okay, there's our full vega number there, about 217. Okay. So let's see what we got. Okay. Imagine Sisyphus happy. I love the love the handle there. But I won't go into that right now. But anyway, um, little Camus there, right? Anyway, let's go and talk about delta here. The question is, can I have a column just for delta and then a separate column where it's beta weighted? Not to my knowledge. It's a good question. That's not to my knowledge. So I wish they were different, but that's how it is. So it'd be nice to have both. But right now we got beta. But you know what? I'll tell you what. It's easy enough to switch to and fro, right? It's just a click to look back and forth between those two. Okay. Let's go and let's look at adding a trade. Okay. And for this trade, what I'm going to do is, if you want, you can add an individual stock trade. You can add, and it's going to affect it to that extent. But if we're going to do an index option, let's go to Analyze here. Let's go to SPX, okay? And let's go to Add Simulated Trades. Let's say we want to add in a trade and we want to lower our overall delta in our portfolio. If we were just to go to, say, SPX and go out, we'll go out about a month here, okay? I'm going to go out about a month. Here's 30 days. And I were to go, say, to a 30 delta and click on my ask price. So this is a long put. I'm throwing in a long put. What would happen if we threw in a long put here? So this is just a simulated trade. But what we can do is we can look at our price slices. Let me just zero that out. There we go. What kind of delta are we looking at? This is the SPX, so it already is beta weighted, so to speak. Negative 30. Well, our overall portfolio was, what was it, 12 or something? 12. In other words, if we were just to do that long put example trade and do that index option, that would throw in negative 30 deltas there, meaning my overall portfolio would have a delta of like negative 17. I would have gone from this nice bullish portfolio to something that's distinctly bearish in that case, if I were to do that. So sometimes that may be a little bit of overkill. Now, if I do a long put on something else, an individual stock, obviously it's probably going to affect it a lot less. Let's do this. Let's go and say we could do a different type of trade. We could do a different index, right? If I go and I trade, I'm going to analyze, instead of the SPX, do the XSP, which is an index option, but it basically is 1/10 the price of the SPX. And we were to do a long put on that. I'll go again to about the 30 delta on that and click on that. And then look at my delta, but if I need to beta weight it to SPX. Hold on. Hold on one sec here. Let me just see if I can do this. I don't want all those positions. I just want to look at SPX, XSP. Basically, what this is going to be, if I just look at XSP, is it's going to be 1/10 the value of, so instead of a negative 30, it's going to be about a 3 delta negative. But I want to go back to SPX for a sec and look at a different type of trade. One that isn't going to be, because remember, if we just do a long call, a long put, if we just do a long put, it is negative delta. Maybe we want that. But a long put is also going to introduce negative theta in it and positive vega. Maybe I don't want that. I already have a portfolio that is very positive vega, and I like the positive theta, and maybe I don't want to reduce that. Well, we can look at a different type of trade here. if I go to SPX, oops, let me get rid of this and go back to my single symbol here. And instead of doing a long put, what if I do a bear call spread? Again, I'll go out 30 days. And I'm going to go out to, I'll go to about a 30 delta, or 31 delta. And I sell this put, click on the bid price, and I'll go to about a 26 delta, and I'll buy this put, not put, I said puts, I mean calls, okay? Sell this call, buy this call. Then what I end up with is what is that? It's a bear call spread or a short call vertical spread. What's my delta on this? About 463. So I'm introducing 463. That would lower my delta substantially, but it wouldn't overwhelm the portfolio like just throwing in that long put in there. Furthermore, it would throw in some positive time decay, some positive theta. That's a good thing. And it would reduce my vega to a large extent. Okay? Any questions on that? Let me know. Any questions? Let me know. So this is a not as heavy-handed approach by doing the bear call spread on the index. In fact, let's just do that trade. We were going to do let me just look, May 22nd, 72.90 and 73.25 call spread, and that was May 22nd. To put that trade on, you go to SPX, you go to your expiration date. I've got May 22nd here. I'm going to go to my calls, and I'm going to go down, scroll down until we hit our strikes, and we said we were going to go to the 72.90. I'm looking at the wrong expiration month. Let me get to the right expiration month. 72.90 and the 73.25. So we're going to sell the 72.90. I just click on it. I'm going to go to the 73.25. I'm going to go to the ask price, hold the control key down, and click on that. There's my bear call spread. Okay, there's my bear call spread on the SPX. And of course, you can do more than one contract. All those Greeks that we were looking at would just double if I doubled the number of contracts. Okay, this is loading us up at the mid price. Probably wouldn't get filled at that, so I'm going to go down here just a little bit. I'm going to confirm and send, and then I got rid of my groups. When you get rid of the groups, then when you're trying to put in an account, it doesn't give you the group possibility there. So let me send that, and we now have a SPX bear call spread in there. And you can see with my delta is now reduced. No longer 12.5, it's now 8.5-ish, okay? My theta has gone up. My vega has gone down a little bit. Look at your overall portfolio, everybody. Okay, now I want to talk about managing some individual positions here. Again, if you have any questions, let me know. Let me restore my groups. To restore my groups, I'm going to go back up here. Let's see. Okay, could you show the steps from portfolio weighted delta to arriving at SPX strike? Okay, let me answer if I understand you correctly on this. If you're looking at the Analyze tab, okay. Okay. I see. I think I understand what you're saying. Okay. There's not a right or wrong answer on this. Okay. When you're hedging, so here's what we're talking about. We're talking about this delta right here. This is the beta weighted delta. All right. You need to ask yourself, how much you want to affect that. We were at, before we did this last trade, we were about 12 and a half. Am I bullish or bearish overall? Do I want to keep a bullish or bearish portfolio overall? Most people generally like to keep a bullish portfolio in total. You may have some individual bearish trades, but most people like to keep that delta positive. But there may be exceptions to that. It's not right or wrong. But when you are trying to hedge a portfolio, think of what level, number one, you're comfortable with it being, and number two, how much you want to hedge if you want to hedge. Typically with hedging, kind of the general rule, I don't know what's called a rule of thumb. Let's call it a common practice, not universal, is to go, if you're just doing, say, something like a long put, to go with a 30 delta. In other words, you're hedging about a third of your portfolio. So whatever trade you put in, you're going to be looking at, if you wanted to use that kind of standard, I want to hedge about a third of the portfolio type thing, then if it's a long put, you'd be looking for something like a 30 delta. Or you'd be looking for something that would reduce this by about a third, roughly there. That's the math we'd be looking at. If I'm looking at a new trade, and let's say we're looking at a trade right now, and it would introduce -6 deltas, beta weighted deltas to my portfolio, and this is my current, that may be, unless I really want to get much closer to a purely just closer to a delta neutral portfolio, that I can't tell you what number that should be at, but that's the consideration. And when you're looking at these and you're trying to decide, this is an easy way. Go to, okay. All right. So sorry, I lost you there for a sec. Just when you're looking at this here, when you're looking at this, you got to just decide where you want that to be and how much it's going to affect it. And the way you can do that, I think most effectively, is go to the Analyze tab, throw in a simulated trade there, all right? And just make sure there's no extraneous trades in here. I've already added that trade in, so let me just uncheck those. And then you can look at the strike prices and look at your delta columns there, okay? So that's how you can do that. Now, if you want to look at your overall portfolio, you can do that as well. I think I'm going to hit that up just because I want to hit up some individual trades here as well. We'll look at that maybe next week. We'll look at looking at your entire portfolio and not just the one, not just adding the one trade in there. Okay, so we'll hit it up again next week. How about? Fair enough? Let's go and look at some of these trades because I want to follow up what we did last week. Last week, we talked about managing vertical spread, iron condors, I think is kind of what we talked about, but really it bled into managing individual trades. Just as a refresher on that, and if you're interested, you could look at last week's session. Just as a refresher on that, what we said is, if the short contracts are out of the money, so here's my iron condor, here's a short put vertical, here's a short call vertical, we're going to manage them separately. If the short option, that's the one with a negative quantity, is out of the money, then what we're going to do is we're going to be patient with it, number one. If it's out of the money, and our current stock price is 256, so it's in between our short prices, it's above our short put, it's below our short call. So if it's out of the money, we're going to look to either get out if we've hit an 80% gain or a week to go to expiration. A week-ish, okay, less than 10 days to go to expiration, or 23 days to go to expiration. So that's not a reason to exit. These are out of the money. The other reason we'd get out is an 80% gain. Well, you can see we're actually losing on the call side. So that's certainly not an 80% gain. If I look at these two together, it's a negative quantity. So we're not at an 80% gain on the call side. So let's just look at the put side here for a sec. We're making some money. Is that an 80% gain though? Well, look, we entered this trade for about 80 cents on that, okay? We entered this portion of the trade, the put portion of the trade, not the whole trade, the put portion of the trade, 80 cents. Right now, the value's about 40 cents. How'd I come up with 40 cents? I just subtracted the one from the other, 40 cents. In other words, we sold it for 80 cents. It's now at 40 cents. That's not 80%. How do I get 80%? Well, you can just multiply the initial quantity by 0.2. 0.2 times 8, or 2 times 8 is 16. It would have to be about 16 cents to get to that 80% mark. So in this case, on Adobe, we're not going to touch it. We're going to close it. We're just not going to touch. We're just going to let it sit. Okay. So let's do that. That's Adobe. Okay. Let's look at Bank of America. We're less than a week to go to expiration. We're about, now we could let this go a few more days if we wanted to, but I usually like to manage these in this webcast, and we're not going to be doing this webcast for another week. So that would leave us 2 days to go to expiration. So with 9 days to go to expiration, whether it's going well or not so well, we're going to look to get out of this trade. The put side, we're up a little bit. The call side, we're actually doing well on both sides right now on this, which often isn't the case, but we're doing great on both sides. So, but using our rule of getting out at this point, we're just going to get out and take our profit on this. So to do that, what I'm going to do is I'm going to close them out. Okay. I'm going to close this out. I'm going to get out of the put side, highlight the puts, right click, create a closing order, and buy it back. Okay. And confirm and send, Okay. So we're out of the put side on that. Now we're going to go to the call side. I'm going to do the same thing. If you want to highlight more than one of these, by the way, just hold down your shift key and you can highlight more than one of those. Now, why am I getting out of the put side and the call side individually? Can't I get out of the whole shebang? I can, but it's often easier to exit one side at a time, the one vertical at a time instead of the whole iron condor. If you want, you could even get out of one leg at a time. We could get out of this leg and this leg, but I'm going to get out of both of those. I'm just going to right click on them. I'm going to create that closing order. I'm going to buy it back and confirm and send that order. Okay. So we're now out of that one. Okay. Let's go to Meta. Okay. So Meta, first thing we should look at is how much time till expiration. Well, we're at time to exit on these. This one side's doing okay, the other not so much. The put side of things, we're doing great on, okay? We're making money. We're going to get out anyway. We're 9 days till expiration. The call side, we're losing money. We're down, what is that, $450 or so? We're losing some money. We're going to look to get out anyway. Let's say we didn't have 9 days to go to expiration. Let's say we had 19 days to go to expiration, or 15 days to go to expiration or something. What would we do? Well, on the side, first of all, are we in the money or out of the money? Current stock price is $6.74. That means the puts would be out of the money. The calls would be out of the money. We could say, well, we're going to stick with them because they're both out of the money unless we've hit an 80% gain, at which point we'd be looking at the side that's doing well, that 80% gain, and see, are we at an 80% gain? Well, look, we entered for, let's see, about 185. That's what we sold it for originally. If I'm doing my math right there, I think that's 185. It's currently about 36 cents. So we're pretty close. We're kind of on the, you may want to, often it's obvious. In fact, usually it's obvious if you're at the 80% gain. This is the one where it's kind of close, or we're kind of right on the border of 80% gain. So even if we had more than 15 days, more than 10 days to go to expiration, we'd probably be looking to exit that one anyway. Either way, we're looking to get out of the whole thing because we're getting pretty close to expiration on this. So I'm going to do the same thing. I'm going to highlight it, create a closing order, buy it back. Does it matter which side I buy back first? No, it doesn't. Very often, if you're getting out of one single contract at a time, let's say we were just left with this short call and we wanted to get out of one at a time, which would we get out of first? Probably the short call first. The reason is, if I get rid of the long call first, I'm then left with just a naked call. And a lot of your portfolios won't even allow that, first of all, but there is that theoretical unlimited risk on that naked call. But in this case, I'm going to get rid of both of them anyway at the same time. So I'm just going to create a closing order, buy it back, and do this. Now let me just double check time, send. Okay. All right. Let's move on. And there's some things I want to talk about, a different type of trade here. That's just kind of a follow-up, I think a practical follow-up to last week's discussion, though, on managing iron condors. Let's go to long single options here. So here's one I want to look at. Capital One. Capital One's actually doing really well. It's a bearish trade. It's a long put. It's a leaps. We got into this a while ago, and the thought is over time we're expecting this to go down, and so far it's cooperated. But here's what I want you to look at. I'm going to get rid of my beta weighting for a sec. That's my delta. My delta is about 89 on this. And one of the rules that we often use, and one of the practices we often use in this webcast, you don't have to do it this way, is when we get to a delta that's above about 85. In the case of a call, it'd be positive 85. In the case of a put, negative 85. So above 85 or higher absolute value, okay? Then what we look to do is we look to roll that delta down to something lower. And the reason is this. If we roll this contract out to a lower delta from the 89 here, we're going to bring in a credit. That's great. Who doesn't want to bring in a credit? That's wonderful. We're taking some of the risk off the table in that regard. We're also moving that delta down so that if the stock goes against us, in this case the stock goes up because it's a put, then it will go against us at a slower rate. Let's say we move this 85 down to 65 delta. Okay, I'll put negative just to be correct on these. Negative 60. Then if Capital One goes against us, then it's not moving against us as fast a rate. Now, there's pros and cons to doing this. One of the cons is if it goes down, if the stock goes down and it's going favorably for us, we're also gaining money on the trade at a lesser rate too. So it's not a universal practice. There's pros and cons to it, but that's a practice we do to try and just take some takes some money off the table, so to speak. Okay? And it takes some of the risk off the table there. So I'm going to look. Now, there's another reason we would look to get out, to do something is we could look to get out if we've just turned bearish on this trade. Excuse me, turn bullish on this trade. It's a bearish trade. If we've just kind of unabashedly just said, hey, this was bearish. We did this as a bearish trade. I'm now bullish on the trade. I want to get out. Then we may just get out of the trade here at this point. Well, it's a little iffy maybe. It's the trend we were taking advantage of and where we made that profit on. That looks like that's breaking. Are we in an uptrend yet now? Well, that's debatable perhaps, but you could do that. So if you're still bearish, our general practice would be, let's roll this. And I want to show you how to roll this. So I'm going to do that. But keep in mind, you could just close out of the thing. Another thing we could do is we could add a stop in the trade as well. But let's look to roll this, and that's probably all we're going to have time for today. So I'm going to go to Trade tab. I'm going to look for my position. You see it's tagged right there. And we can scroll down, find the position. There it is. Okay. There's that 90 delta. I'm going to roll it down to something between 60 and 70 delta. I'm going to roll this to the 230 strike. December 18th, 230 strike. I'm going to right click on my position, on the position statement. I'm going to create a rolling order. I'm going to stick with December 18th. And I'm going to make this a 230 strike. And when I do so, it's giving my credit. That's a $5,200 credit this is going to be bringing in here for that roll there. So that's the trade. Why did I normally when we're entering these trades, we're looking very kind of standard in this webcast, we're looking maybe 60, 70 delta. That's why I chose that 230 strike. Okay. This was above our 85, so that's why we got rid of this. I'm keeping the same expiration date. So that's the trade. Keep in mind though, rolling doesn't save you commissions, okay? We're just kind of doing it in one order ticket and you can see it just like that. So let's do this. Let me confirm and send. I'm going to send this trade. It hasn't filled. Actually, I want to force that to fill because I want to show you something. So I'm just going to move this price over, send that. Oh, is it still not filling? I'm running out of time. Let's try it one more time. I'm going to go all the way to the natural price. It is not wanting to fill on us, folks. Well, I'm just about out of time. But what I'm going to do here is, yeah, I don't know why that's not filling. Let me try one more time. Yeah, not filling. In any case, what I will do is once I get this to fill, once I roll that out, I will, and we can always do it as two separate trades, get out of this one and enter the next one. That's how we'll do that. But what we'll see is once we do that, our PL open will zero out at that point. Okay. I'm going to then add a stop in here. I don't have time to do it today, but once we get that rolled, I will add a stop into that trade there to try and protect us, especially because, I mean, probably best practice anyway, but especially because this is starting to not look as bearish as it was before. So that's why we're going to do that. All right, everybody, I hope that helps. That is all I have time for today. We talked about looking at your portfolio, beta weighting, We talked about that, adding in trades, deciding how that trade is going to affect the overall portfolio. We talked about managing some different trades. So I appreciate you. I appreciate Mike for helping me out in the chat. Coming up next, we've got trading price patterns. Make sure you subscribe to that Trader Talks channel. Appreciate your participation today. And everybody have a wonderful rest of the day. And we'll talk to you later. Bye-bye.